the next type of bond that we're going to talk about is a callable bond, and these are actually pretty common. Essentially what this means is that this gives the company the right to call the bond at any time or within time specified. And the right to call is essentially the right to repay early. So initially you might think, okay, well, that's a good thing because the person's who's invested is going to get their money back earlier, but it isn't really. It's a benefit to the company, because if you think about when would they actually exercise the right to repay, it would only be that if interest rates went down. So, for example, if they issued a bond and the rate of interest was 3%, and then it goes down to 2%, then they'll repay the existing bond and issue a new one at 2%. But the person who invested wanted to get the 3% for the term of the bond, and now they get their money back, and now they need to find another investment, but now the new investments are only paying 2%. So it clearly favors the company that's issuing the bond, and it's one of those things that an investor would prefer that feature would not be on there. But a lot of companies put it on just as a precaution if they think interest rates might fall. The opposite of that is a puttable or a retractable bond. This one gives the investor the right to be repaid early within certain parameters. So this one clearly does favor the investor, and as a result, you don't see a lot of these out there because it can cause problems for a company. So if the investors really just going to exercise that if the interest rates start to go up. If interest rates go up, the bond they're holding isn't as attractive. They exercise their right to get repaid early, and then they reinvest in a higher rate bond. The problem it creates for the company is they may not have the cash available. They probably don't, because it's a large amount to repay. So if the investors exercise this and ask for the money back, the company is essentially going to have to refinance it on the marketplace right now. And odds are the interest rates are higher at that point, just because that's the whole reason that any investor would have exercised that feature. If interest rates were the same or lower, they would have just held the bond. And as we did from the last tutorial, the principal is by far the largest portion of the cash flow, so it could have a significant unplanned cash flow impact for the company. And the last one I'm going to talk about is a convertible bond. And this is a bond, as it sounds, is convertible into the common shares of the company or into equity, usually common shares. So it's a feature that's an added benefit to the investor, particularly if you're buying a bond in a company that you think the shares might go up. So in this case, essentially what's happening is you're guaranteed, as long as the company doesn't default, you're guaranteed to get some interest on the bond, just like it was a regular bond. However, you also have the possibility that if the company's shares go up significantly, then you can exercise it and convert it into shares of the company. So in a way, you might not be getting the full benefit of a share price increase that a common shareholder would, but you're also not getting the same exposure to if the price goes down. So if the price of the shares doesn't move or it goes down, you just collect your interest. If the price of the shares goes up a lot, based on the conversion ratio specified, you could end up making much more money by converting to the common shares because it's more profitable. And as a result, companies will usually offer these at a slightly lower than market rate because of that feature. And it's good for certain companies that have implied growth. High-tech companies tend to be a good example of this. If you have a company like Apple or Amazon, where people are thinking the share price could go up, and it's a long-term bond, like a 5-year or 10-year, then it might make sense to have that feature, or it would be beneficial, certainly, for the investor to have that feature.